Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. Well, we missed him again. He's in another due diligence assignment, Mr. Michael Becker, the governor of the great state of real estate here in Texas. So we wish him and his group over at SPI the best. Sitting in the podcast with me is the professor himself, the smartest guy in the room today, Mr. James Eng. James, how are you?
I'm doing good, Paul. Thanks for having me.
Anything coming up in the Old Capital world, James, that we want to let everybody know about what's going on?
Yes, Paul and I, we were going to meet at a barbecue place, and we just pushed it out and said, hey, if you want to have barbecue on in November, come swing by. And then 75 people decided to join us for lunch. So
it was quite a few.
Yeah, so we had to get a slightly bigger place. So in December, we're going to have a lunch and learn. We're bringing one of our friends from GREA over to just talk about the market. So go on to oldcapitalpodcast.com. You can register for that one. And then in January, we're kicking the year off with a bus tour. So January 10th. But go on to oldcapitalpodcast.com and you can register for both of those events right there.
You know, we always say is that you have to go out and meet people, whether it's limited partners or other people that help you build your team. This is a great way of coming out and being part of a group of kind of listening to what's going on, see if this is the right thing for you to do before you spend your hard-earned money in investing in apartments. To probably break your chains of having a W-2 income, you want to come out and at least meet some of the people and listen to some of the stories about what's going on in apartment investing. So we have a person and his teammate that we've known for a long period of time, James. I think you guys used to work together at one period of time. James is going to have kind of talk a little bit about that. But, he was on a podcast with us, back in, a long time ago. I think it was episode 238. He tells me, I would take it that what it was. But at that period of time, he was a W-2 employee. And as a W-2 employee, you want to get to the point that you're not going to be a W-2 employee. You want to be self-employed, or you want to go from the back of the airplane, being a limited partner, to being the front of the airplane, of being a captain and making the decisions yourself. You want to be able to buy an investment property and then you want to run it. So today in the podcast, we're going to hear the story about moving from a W-2 employee, moving into the captain's position from, again, two of our friends, but Jeremy Thomason and Stephen Quesinberry, and they've joined us, one from Dallas and one from Atlanta. So we'll talk a little bit about how they met, how they got together, how they bought some properties, how they formed their team. And James pretty much knows the entire story. So I'm going to turn it over to James. James, lead us in the discussion, please.
All right. So thanks, guys, for joining. I think maybe to kick it off, maybe just do the 1 minute elevator intro for both of you guys before we get into the story. So maybe Jeremy, kick it off, and then we'll go to Stephen.
Okay, so the 1 minute is Jeremy Thomason, and I'm here in the DFW market. I met James when we were at GE 15 years ago, and James is who I credit or I blame for hooking me on the drugs that are multifamily about a decade ago. And since then, gone from the back of the plane to sort of the co-pilot and then in the pilot chair. And then, as Paul alluded to, the pilot, you can be a W-2 person and also have a pilot job, but at some point you want to just fly planes for a living. And so that's where we're at now. And so we'll get into that more, but that's who I am. And then my partner, Stephen, is in the Atlanta market. I'll let him introduce himself.
Yeah. Hey, guys. Yep. Hey, James. Thanks for having us. Really appreciate the time here. Yeah, so similar to Jeremy, started off in single family space and did some small multis. I was a former military officer and then went corporate in about 2015. I caught the real estate bug 2014, 2015 timeframe and really started dabbling and just kind of took a step back like most single family investors do. And how am I going to scale this? And so that's what kind of led me down the path of exploring multifamily real estate. And it's pretty full circle because the Old Capital podcast is one of the first resources that I remember really latching onto, probably the 2018 year. So I started out as an LP investor, passively investing in deals, many of which are in the DFW area. And that's kind of how I kind of got accustomed and learned the industry and learned the multifamily landscape. And from there, gravitated towards becoming more of a GP. And that was something that at that time I was starting to want to become. And so we can talk more of the origin of how we formed, but we started forming in 2021, 2022 timeframe. And from there, I've been, looking for good deals since.
So maybe Jeremy, go back to you. Let's go through the checklist of positions you have been in throughout your career, and then we'll go over to Stephen. And what I want to see is like the crossover point between you and Stephen. Maybe Jeremy, touch on sort of your background and what you did before all this.
Yeah, so I'm born and raised in Texas. So I went to Texas A&M and am a finance major. So
Gig'em.
Gig'em, that's right. When I graduated, I started working in commercial lending. And so with that background, I think it's a strong place to have. It's like a banking background, even though I wasn't technically a banker, I was more of a commercial lender. But the skills that you learn as a lender and as a financial services person, I think are invaluable. And I was doing that. I thought I was going to be a lifer in it. I really did. And it treated me fine. But in 2002, when I moved back to Texas, at that point in time, I was at Citibank and they had moved me around a lot. I moved back to Texas and I bought a foreclosure house, a single family, 3-bedroom, 2-bath, 2-car garage for $100,000 in Allen, Texas. And that started my addiction that really actually did fine for me throughout the next decade. I kept buying them, but I ended up having the scaling problem that Stephen was alluding to. And along that path, I got bought by G Capital, and that's where our paths crossed, James. And as GE was sort of winding down, or G Capital was probably better said, G Capital was winding down, you ended up at Old Capital, and my business was bought by Wells Fargo as a going concern. So we were in two different businesses in G Capital, and now I'm at Wells Fargo, and I have passively invested alongside James Ng in some deals that we did with our friend Chris Faulkner, who has been on this podcast as well at CAF Capital, based out of Frisco. The reason that I did that was I wanted to put my money in a deal, but I actually was one of those guys, those weird guys that was going to read the stuff that the sponsors send out. And it was on purpose that I invested because I knew that if I put my money in and I paid attention, that there was a likelihood that I was going to like this given my background in single family. And that's in fact what happened. I read the stuff. I really got a lens of how I wanted to be treated as a passive investor by the sponsor, which shapes a lot of the strategy that we have today. Didn't really ever have any bad sponsors, but the difference between sort of a sponsor that's a okay sponsor and one that's sort of first class and how they think about their investors is an important part of how we have been building Convolo Capital. And so as I was at Wells Fargo, I was starting to do deals, and you were certainly very involved with the networking part, got very familiar with the Old Capital podcasts. And it was really a sale. The sale to Wells Fargo sort of created this point in time where I was like, do I really think that I'm going to be a Wells Fargo person for the rest of my career? And the answer was like, I don't know. And it was my boss left our company, and he'd worked there for 20 years, and he ended up working at a company called CoreLogic. And CoreLogic was at the time a public company that was a real estate data and analytics company. And they had a division called Rental Property Solutions that they needed me to come run sales for nationwide. That's what I did. And so all of a sudden, I am now a W-2 employee, but on the supplier side of the multifamily world, selling screening, renters insurance, going to all the trade shows, learning the business from a sort of supplier side. And that was really helpful for me because I was being paid to go to trade shows that I would pay to go to. And so it was just a great synergy for me. And it was there in the program that Stephen was referring to that I met Stephen and one of our other partners, Curtis, who's not on the call today. And so I met them there while we were at CoreLogic. And it wasn't hard for us to sort of quickly realize that we had a lot in common just with how we roll, with our values, how we are with just thinking about real estate and investing part of real estate. And so now I am leading sales for a large public company on the rental property side of things, but I'm also now, I've been a passive investor in too many deals that I can count. And one of your introductions had me brought into the co-pilot seat to GP a deal. And that was a great opportunity for me to sort of see how the fundraising part of it worked, could sit in the asset management chair to some degree. And then everything was going great. And then COVID happened. CoreLogic decided that they were going to divest some of their business units, and they decided to divest the rental property solutions division that I was leading. And I then became the person that had to figure out how to sell our business unit. And we were successful at doing that. But on the day it closed, or actually the day before it closed, they came to me and said, "Hey, JT, great job. We're closing tomorrow. But the buyer told us last night that they're not taking the executive team. Today's your last day." And that happened. It was, I'm a religious person, so I was a little dismayed as people that are laid off can be, but I wasn't at the same time because I believe that these things happen for a reason. And within a few weeks, I found myself in Chris Faulkner's office in Frisco at CAF. And I was just wanted to hear his story because he had a similar story whenever he left GE a decade before. And for all intents and purposes, Chris hired me on the spot to come in and lead their investor relations team. And at that point, I knew that I was in a place that I really like. CAF has got 24,000 units today, vertically integrated. Institutional capital is how they fund themselves. And it worked really well. At some point, then I became the leader of asset management for them. And so now I'm faced off with all of the institutional capital, household names that everybody's heard of. And I'm living sort of the dream of being in the throes of it. And my ability to still do deals on a smaller scale was still there, but I was very, very occupied with my job at CAF. And as we all know now, the last couple of years, if you're an asset manager, you're earning your stripes because of how much challenges we've had in our industry the last couple of years with the interest rates going up. And so that's been part of the evolution for me, is really understanding asset management, really understanding what the institutional capital wants. A lot of people that are listening are enamored by the idea of big check writers. And I can tell you, yeah, big check writers are great, but they are all up in your business all the time, as they should be whenever they're writing $30 or $40 million checks. And so we and my team was facing off with all of those institutional capitals whenever time was tough. Along the way, I'm still friends with Stephen, of course, and I recruited Stephen to come work with us at CAF. And so he came over and started doing acquisitions really at the wrong time, whenever acquisitions all but stopped. But he started doing acquisitions for us, and then his multifaceted skills allowed us to tap him into the investment management side of what I was doing also for CAF. And so that's how Stephen and I really started doing business together, in a sense, because we were basically employees of the same firm, or of the same firm again, as we had been originally at CoreLogic a few years prior. And so I'll let Stephen sort of pick up the story there, because it was during that time that Convolo Capital was born.
Stephen, yeah, go ahead and pick up the story on terms of what you guys have done out in Atlanta, and then we can get into this deal that you guys recently bought in Dallas.
Yeah, and I'll kind of take you a little bit to the origin of us. So to rehash my story just a little bit here, is that when I started investing as an LP, I was doing so because I felt like there was a strong possibility I wanted to do it as a GP in the future. I just didn't know when that might be, or if I wanted to do that full time. I wasn't quite sure. I had a strong inclination towards it. And so, COVID happened. I was in a sales role at CoreLogic at the time. And around that time, I was really starting to dig into underwriting. I really latched onto the underwriting piece to really understand what good deals looked like. And around that time, you're taught, and kind of the first step is to assemble a team, right? And so Jeremy and Curtis and I had a lot of conversations previously. And, I think from my standpoint, Curtis was a great partner to be very actively involved. And then I knew that Jeremy was an executive at CoreLogic at the time, soon to be CAF, and he may not have the time capacity to be actively involved. But where I felt like he could plug in seamlessly was kind of as that anchor partner that, maybe has the net worth, the liquidity piece, the experience with Fannie and Freddie, because those are key pieces that Curtis and I didn't have. And so rather than just assuming that Jeremy would be open to the idea, I kind of pitched it as like, hey, do you know anyone that might be interested in doing something like this? Just to kind of set the bar low. And Jeremy was like, hey, I'm happy to do this and would love to partner with you guys. And so that's kind of how we started. We started in that 2021 timeframe where it was just impossible to find deals and everything was being underwritten by bridge debt and nothing made sense. We were getting outbid by $1 million on deals. I remember that sticking out, and it just felt like it was very difficult and it wasn't going to get any easier. And so we kind of did a little zagging because of that. And instead of chasing something in the center of Atlanta or in a hotbed of activity with a lot of competition, Curtis and I started gravitating towards more pockets of growth that, maybe had some future runway and some high traffic potential areas that had potential for growing. And we started looking out in those types of areas at smaller deals. And I think that's kind of where we started to niche down a little bit. We started with a smaller deal in 2021 and put fixed rate agency debt on it at 3.7. And, ever since then, we did fixed rate agency debts. And I'm not going to pretend like we're incredibly insightful and knew what was going to happen with interest rates. It was just, we felt like the deals that we were getting into were stabilized and good candidates for agency debt. And it just kind of made sense. And so that's how we got started in 2021, 2022. And ever since then, we've been kind of executing this strategy of looking for deals that maybe don't have that heavy value add execution, but maybe a little bit more light value add play. Maybe there's a dislocation with the loss to lease, or maybe there's some exterior needs, but nothing like incredibly heavy. So that's kind of how we got started. And again, Jeremy and Curtis and I have been working together for a lot of years and had that partnership and that common core values. And I think that's extremely important when you're looking at new partnerships. And that's something that any new investor that's looking to be a GP, I think that's the number one thing you start with is, what is my team? What skills do I bring to the table? What do I need in a partner? And really, really vetting that partner. You want someone that you can count on in the trenches.
So remind me again, how many properties or units did you buy in each one of those years? Like 21, 22, 23, 24, roughly, ballpark?
Yeah, I mean, we only bought one per year. That was 21, we bought one, 22, we bought one, and then 23, we bought one. And all of those were under 50 units. And what we were doing there is kind of a proof of concept with not only as we're building our equity investor base, but also with the brokerage community in the Atlanta area. And what we have found is that while there's some disadvantages with smaller properties, and I think all roads eventually lead to the bigger properties, there is some advantages with the smaller properties. There's a lot of mom and pop operators, which we've noticed. There's a lot more off-market deals. And it's way easier to stand out amongst competition as a buyer on the front end. We've found that there's not a lot of credible groups, or it's 1031s, or someone has a check they need to place. It's been a lot of that. And so the brokers in the Atlanta area have really gravitated towards us as a credible group that can execute in those types of transactions.
No, that's perfect. And then so 21, 22, 23, all three properties were bought in Atlanta. And then in 2024, how'd you decide to come to Dallas? Or Jeremy said, we're going to Dallas. How did you guys make that decision?
Yeah, I'll let Jeremy take that one.
So we had 4 deals in Georgia, and Stephen continues to look for deals there and do all the things that you need to do to be networked well to find those deals. And we actually had a meeting. There's four of us. Jamie Long is the fourth partner, and he was a friend of Curtis's from UCLA Business School. So the four of us are Convolo Capital, and we, for all intents and purposes, had a strategy meeting at the beginning of this year. And it went along the lines of, I told them, was like, we've got to get to DFW. It is the best market that there is. I just got through going to NMHC annual, and every metric there is shows that this market is the best market for a lot of reasons. Landlord friendly state, migration, illegal or otherwise, helping out. And we need to get here. And so let's figure this out. My issue is I just don't have enough time given the role that I had at CAF. And Stephen fortuitously said, hey, you know what? We can back you up. You've got the broker relationships already. You know James Ng and Paul Peebles, so you know everybody. And so therefore, let's figure this out. And then almost as soon as we said that, I really got the opportunity at CAF to leave CAF in a very friendly way to come and work for myself at that point. And Stephen was right behind me. And the bosses there at CAF, they knew that this was sort of our passion and dream. And so as soon as we made that declaration, I'm meeting with all the broker groups that have groups that are under 100 units. We still believed in the under 100 unit sort of view. And I guess I'll take a step back and say why, as interest rates spiked, as a lot of syndicators that had sort of grown up in the last 5 years have had struggles, a lot of them are washed out. The CAFs of the world do not really chase deals that small. It became very clear to me that there was an opportunity in that sub 100 space in markets that were tangential to really strong markets like Atlanta and Dallas, that if we could go find deals in that space, that there wouldn't be a ton of competition. And on the equity side of things, equity is much more difficult than it was a few years back. We weren't going to get out over our skis trying to go raise $10, $15 million in a syndication. Even though I've done that before, it's just much harder to do. It felt like that there were several different things congealing around full-time Dallas. Let's go find a deal. Let's go find a deal where we have multiple ways to go at the equity. And that way, if any one of them doesn't work, we have multiple ways to get the equity. And that continues to be the hardest and most important part in our view, is finding the equity on the deal. And so that's what led us to the Woodwind opportunity, which is a 64 unit deal in Irving, sort of the north part of Irving. That was a marketed deal. Our friends at Rowan had the listing. And just as soon as the declaration was made that I'm like leaving CAF to work full time at Convolo, I started touring deals, and this one was out there. And, I looked at it, toured it, and sort of liked the bones of what I saw, brought it back. And Stephen, within like 48 hours, had the thing completely spread. Just, he loves to underwrite and get in the model. And he called me up and he's like, hey, I actually think that one works. And I was like, oh, really? I mean, I was almost surprised because nothing ever seems to work. It's sort of that I don't know if it's PTSD from looking at deals and never getting them, but effectively it was like, okay. Then we really got into it. And, long story short, we were awarded this deal, I think in part because as we got through the rounds of sort of best and final, we were one of the more credible groups that were offering. I don't know much about who the other groups were, but the feedback that I got was, look, you're as experienced, if not more, and you already own or a GP on about 800 doors in the Irving market. And so when you pull all that together, the most surprising part about the whole process is when we got to the second best and final, which is sort of a joke. Whenever you hear best and final for the audience, remember there's probably going to be one more round, 2 rounds, however it goes. They actually came to us and said, hey, believe it or not, the seller wants to do buyer interviews. And we're like, okay, let's do buyer interviews. I thought like, okay, I've done a bunch of buyer interviews on large deals as a part of CAF. And I was like, I know we will present very well on a buyer interview panel. I'm not trying to be cocky. I just knew that given the size of this deal, that if we got on a buyer interview and could give them confidence that we could close, we bring our friend James Ng in here to vouch for us on the debt side, and we'll have a package where we may win the deal and not be the top price. I don't really know that, but I sort of feel like that's what happened.
Oh, that's what happened because we had group number 2 that was competing against you. And that group number 2 was not as strong as you two guys were, or the company. Having other properties in and around the marketplace itself, and having knowledge that Jeremy was a player that the broker and the seller could count on. Because it's sometimes today, it's not the highest price. It is the ability to actually say you're going to close and actually close. Usually wins the deal. So the group that we kind of represented, it was their first play into the market. So they hadn't owned anything. And so they were coming from behind. They eventually went on to buy something else, but they certainly did love this property. And I've closed on that loan maybe 2 times in the last, say, 25 years. And so I love that property. I like the location of the asset. I like the construction of the asset itself. There's a big pool in the front there, beautiful offices when you walk in, and that, it was a good looking asset. So I commend you guys for winning that deal in a competitive marketplace, but I don't think you had the highest price, but it was the commitment to close. I think it was what you guys.
Well, thank you for validating that. We sort of thought that, but it's actually whenever you are talking to investors and you can say that. I mean, thinking about this from an investor point of view, if the sponsor that I'm potentially going to go put my 50 or 100 grand with can actually say that they won this deal, even though they weren't the highest price, because of their experience, because of their relationships, that's confidence inspiring if you're a passive investor. One of the many things that we did say about the deal is that we feel like that we were awarded this deal because we knew we could close. And I feel like it's compelling probably at this point to probably get into the story of the deal itself, because every deal has a story, even after you're awarded it. And there was a story for this one as well.
Let's hear it.
So, Jeremy, before we jump into that, do you remember, you don't need to say the price, but what were like the rough terms? Because I think this is something that it's always moving around and every deal is different. But do you remember the rough terms just in terms of like closing timeline, earnest money, non-refundable, all that type of stuff? Just because I think a lot of people they sort of start in this sort of sub $10 million range.
Yeah, I mean, our first sort of offer, we knew we underwrote it. And so we underwrote it to a price that we sort of felt like, okay, here is our walkaway price. But we didn't offer our walkaway price because we knew there was going to be at least one round of this. And we came in sort of under by about, I want to say it was about 300,000 below where our sort of walkaway price was for LOI number 1. And in LOI number 1, I think we put a 90-day close. I think we had some structured hard money. So some hard money day 1 that was, I think it was 40,000 day 1, and then another 40 after due diligence period, or the 30 days of due diligence were up, physical due diligence were up. So we had some hard money up front that then became even bigger as we got into the deal. We knew that we were going to use agency debt. And so that was a part of it. And really, those are the big, I think, salient points of the structure as we went into LOI number 1. And so then we were told there was 11 or 12 offers and that they were going to select 5 to go into best and final. And so we then modified our deal a little bit as we went into best and final. Didn't really change the hard money, brought the price up a little bit, but still had room below where our walkaway point was. And then the feedback that we got from the broker was, hey, that 90-day close, that's longer than everybody else. And so we modified that to I think it was a 75-day close at that point, whenever you count the extensions. And that seemed to be sort of copacetic for where deals were trading. Hindsight on this, which is sort of teasing a little bit about the story, we sort of wish we'd actually asked for more time, and nothing because we weren't performing, but there's a lender involved in these deals. And so we'll talk about that here in a minute, but I think that was the main sort of points. And I guess the very, very last, after the best and final, after the buyer interviews, Rowan reached out and said, I could tell, I've done this enough times, I could tell they wanted to award the deal to me. And so he was just like, can you get any more price on it? And I hung up and I called Stephen. I was like, look, they want to award this deal to us. Let's put $25,000 more, which is just, it's like a rounding error in deals this size, but it sort of shows them that we are serious about this. And so we did that. And you could tell whenever I made that phone call to the broker that he was elated because he could say that he did his job to go get a little bit more to his customer, the seller. And then within about an hour, Rowan calls me back and said, look, you're getting the deal. We're awarding this to you. So that's how we got to really getting into the deal and the due diligence piece.
And that was May of this year.
Yeah, May of this year. We wanted an early access. I should have said that. We wanted an early access because we knew that from the time of LOI acceptance until PSA getting signed, that if, I've done this a few times. And so there's a way to get in and see the property, see the bones. Paul, do you have something to bring?
No, the only thing I was going to ask is to make sure Stephen was telling us this was not a distressed asset.
Right.
This asset was a stabilized asset. So it wasn't going to be a bank loan. It wasn't going to be a bridge loan. It was going to be an agency, a Fannie Mae or a Freddie Mac type of loan. Is that right, Stephen?
Yeah, that's correct. Yeah, we
stabilized. And I'll hand the baton here to Stephen because he was really in the weeds with the debt part of this, working closely with James. So we divide and conquer as a group on who's doing what. I was the local guy. So I was during the early access agreement period, which is about 2 or 3 weeks between awarded to getting the PSA signed, and the lawyers are all cool with what the documents are going to be. We were able to go on site. I brought in a trusted large contractor to do an on-site due diligence for us. And that made us feel a lot better about our money being hard. You could walk around and see that this property was in decent shape, but you never really know. And so you want to have some people that are sort of trained to think about, hey, what do foundations look like? What do roofs look like? What's drainage look like? Do you have HVAC issues? The big ticket items. And we did that. And while we could see that there was definitely going to be things that we needed to do to the property, there wasn't any showstoppers. And we were able to do that during the early access period before our money, a dollar of our money went hard. And that made us feel a lot better as sponsors because you put hard money down, that's coming out of your sponsor pocket. You're not going to ever have an investor that is going to front the hard money for you and walk away with it unless you're talking about institutional folks. I would never subject a syndicated partner, an LP partner, into a hard money situation if we had to walk away from a deal and lose our hard money.
So Stephen, let's go through. Okay, so you guys get the deal under contract. You start the loan process. We ended up going Freddie SBL, which you guys have done before. And take me through what you remember. Obviously, we've done a lot of loans, but take me through the main points. We'll try to run through this relatively quick, but take me through the main points of this deal and sort of the loan process and closing process.
Yeah, so I think when it comes to the lending piece, right, every deal may fit a different box for Freddie or Fannie, depending on the characteristics of the deal and what your plan for the deal may be. And so for us on this particular deal, obviously, as Paul alluded to, we were kind of rolling out right up front any bank or debt fund options, and we were strictly looking at Fannie and Freddie. And for us, we looked at it a number of different ways, but I think first and foremost, it started with where interest rates were during the time of the deal. And everybody knows this summer has been pretty volatile. Even, Q3 as we start the interest rate cut cycle, it's been all over the place. And so for us, we looked at, okay, interest rates, possibly we don't have a crystal ball. We're not in the business of predicting, but we're looking at it as this is possibly the highest point in interest rates where we could be. For us, prepayment flexibility or predictability with a step down was paramount and very important to us. When you look at Fannie having yield maintenance options, usually those types of options, when you model those out, you need to be in a deal. If you're doing a 5-year Fannie deal, normally you want to be in that deal at least 3 years in order for that yield maintenance to make sense to prepay that in year 3 or 4. And so for us, we're looking at the possibility or the likelihood of maybe interest rates come down significantly. And so we definitely wanted that flexibility, regardless of whether we were paying a little bit extra in interest rate right now. And so for us, that was what Freddie Mac gave us. from there, it was a decision of, okay, do we do a 5-year route or a 10-year route? And I mapped out all the potential options when it comes to 5 and 10-year, looked at whether it makes sense on a 2, 3, 4, or 5-year hold and how much debt service you would be paying, offset with how much prepayment penalty you would be paying. And every scenario that I came up with in year 3, if we had a 3-year hold, if we had a 4-year hold, if we had a 5-year hold, we would be better off if we did the 10-year loan because we're paying a little bit less in interest rate, even if we're paying a slightly more in prepayment penalty. So for us, the 10-year loan made a lot of sense, even though it is at a higher interest rate. It gave us a better interest rate, and it also gave us better interest only as well. And so those two things kind of lended itself to making more sense on the 10-year. So I'll pause there, see if Jeremy has anything to add, or James, if there was any other context you wanted to add.
Yeah, I mean, Freddie SBL, when you sign the loan application, your interest rate is locked. So as long as you get the package into Freddie, you're all good. And Freddie changes it. It used to be once a week, but now they change it whenever the hell they want to change it. You know, it could go up 15, like literally last week, it went up 15 basis points. The next day they changed it and went down 15 basis points. So if you miss it by one day, it could cost you 15 or 20 basis points. Whereas Fannie, you're essentially on the roller coaster the entire way before you rate lock. The deal works with SBL and you put $10,000 down for your loan app, you can just you're safe in that regard. And what happened on this deal was essentially we had the SBL locked in, the rate locked in, everything worked. We're going through underwriting, and 10-year probably dropped 50 or 60 basis points. And so we started looking at, all right, we moved this over to Fannie. How much of a difference does it make in terms of proceeds and interest rate and all that type of stuff? But in reality, it just didn't make sense to move over at the time, just in terms of acquisition is very different in terms of a refi. We did get the deal submitted in the Freddie within the 35 days to sort of hold the rate. But just at this time, because rates were going down so much, the number of deals that Fannie and Freddie were getting was just extremely high in terms of the staff that they had. Usually it took about 10 business days for them to turn it around, maybe 10, 12 days. And this time I think it took 15 to 20 to get us feedback on this deal. And the feedback was, let's say, challenging in some regards in terms of what they wanted. Things that we had never seen asked for, they asked for. I don't know if, Stephen, you want to pick it up there and just, I can't remember which month. Was it September? I think it was September.
All blend together.
Yeah, so pretty much we were teed up to close at the end of the month. Everybody was good with that. Freddie had plenty of time. We sent it to him at the beginning of the month, so we had plenty of time to get it closed. But they just came back with some items on the PCA or engineering report that they wanted fixed. And you guys had already, like Jeremy had mentioned, had already had someone out there and had done detailed reports in every aspect. I don't know if you want to pick it up there and sort of tell the story from your guys' side.
Yeah, I think on this particular deal, the challenge that we ran into was lender require repairs, and it really stemmed from the PCA. There was some deferred maintenance on the property, and clearly Freddie has become more picky and very more detailed on their PCA review. And so for us, we're anything that they need, we're knocking down and doing really quick turnarounds. And so the kind of the gamesmanship here of this all is that in reality, as a sponsor, it's not quite in our best interest to get all of our funds locked up with the lender to have a huge amount of lender require repairs. And so for us, we want to make sure that we're fulfilling our obligation to the lender and impounding escrows that are needed to repair certain repairs that are needed. But we don't want them to come back with everything that we find, because then, all of our capital will be at the lender. And so for us, we did our due diligence as we normally would. We had, as Jeremy alluded to, we had foundation experts walk the property. We had general contractors. We scoped out what do we want our unit renovations to look like. And so the first one that came back was the foundation. So during the PCA inspection, the PCA inspector noted that the foundation in one of the particular units was off and would need some funds held back for that. Well, that flagged with Freddie, and they immediately saw that. They wanted more of an explanation behind that rather than just like, hey, this unit needs to be fixed. They wanted a broader explanation to what was going to go on, how it was going to get remediated. We provided that within 24 hours. We had the report. We modified exactly what they needed. We turned it around with them in 24 hours. And then, James, you can probably attest to this, is like it kind of felt like it went back into the queue at the bottom of the stack, like someone's paperwork on their desk. It went to the bottom of the stack as soon as we turned it in, because then we were waiting like 2 or 3 days at a minimum, from what I remember, before we heard anything back. Then they came back with another request. This time, I believe it was the fascia and the siding and some of the water repair or water runoff that needed to be done. And it was a very similar instance, like someone picked up the stack at Freddie and they've said, hey, what is this? We need more clarification on this. Immediately, we jumped on it, jumped into action, and got more explanation, more detailed review within 24 hours. And then we were sitting there for, I think, a week that time. There was a little bit of slinky back and forth when it comes to the PCA. And I think that was kind of what you were alluding to with a lot of the workload that Freddie was getting. That was a big piece of it.
Yeah, I think it was a combination of timing in terms of sort of when the deal went in terms of where interest rates were going. So it was lower interest rate time. They were just getting hit with a lot of requests. But then also a relatively new sort of team on the Freddie side in terms of property review team, where it's not just the underwriter who's sort of reviewing the engineering report. Okay, what's immediate repairs is 10,000. Okay, make sure you're holding back 125%. Okay, you're good to go. Almost like an engineer reviewing the engineer and saying, well, you want this reviewed, like, let's not do it post-close. Let's do it right now. And it was almost to some extent like, this is not a refinance, guys. Like, this is an acquisition. So going back and telling them to fix certain things, I mean, I guess you can request it, but it's not customary. So it was just a lot of new things that were coming up that we would normally not see on an acquisition finance deal, maybe on a refinance, but not on acquisition. So I guess anybody who's going sort of through the Freddie SBL process, it's almost like get the engineering report, make sure it's reviewed by the proper people on the lender side, and almost maybe cross-reference it with your due diligence report that you do, and make sure that everything that the lender's inspection has sort of called out, or even if it just says something broad like this should be investigated, like that's just like too gray for these guys. And so you just need to almost have like a couple page report from a third party on that issue, because if they did, and luckily you guys had already done all this. And so as soon as they brought up an issue, it was like, yeah, here's a report and here's how much it's going to cost. And let's just add that to the scope, because the initial immediate repairs were pretty low on this deal, and then it ended up being a little bit higher because of these items.
I feel like that part for aspiring sponsors, it can't be understated enough or overstated enough, because we have a budget for all of the deferred maintenance that's well in excess of what the lender was requiring. But the gamesmanship of, if we gave them that budget, they'd say, sure, we'll impound $500,000.
Yeah. And
that's not a position that you want to be in. And so we got their initial lender required list and call it 50 grand worth of stuff. Okay, fine. We go through it. Makes sense. And the frustrating part for us was the dates, the closing dates. We got them from James and Ricky and Freddie. And then we get to that date or right before that date, and then they bring up an issue that would have been an issue on the PCA report that they've had for 45 days. And so that's where we were all just like, what is going on here? And so thankfully, we had an ability to turn around whatever their issue was. We would immediately submit to them. I would go in and say, here's my big, huge list. I would work with that contractor and say, they're really only working on this piece of it. Let's take out all the rest of the stuff and give them this piece so that they can see it. And we did that within 24 hours, 2 different times, that we would have been scrambling on if we had not had big reputable contractors that do this all day long and have been doing it for 50 years in our camp. And so that was huge. Now that happened 3 different times, and we got to the very end of our last day in extension, And now we're at a problem where we can't close on the last day. And so that starts to become a problem because we're going to potentially be out of contract, and nobody wants to be out of contract. There's hard money. And while the seller, I think, knows that we're reputable, we're going to close, we're doing everything we can. We sent all of our equity to escrow that we knew we needed. So our equity is at escrow, and we're just waiting on the lender funds. And now we can't close on the third round of Freddie giving us a new date. And so we have to negotiate an extension beyond our original extensions. And that was super stressful for us because now the seller is saying, hey, put up 5x what your original hard money was, and we'll give you a week extension. And we're like, that's crazy. I mean, it's just crazy to think about. So we had a whole bunch of negotiation, had to do that 3 different times. Very stressful. We were actually out of contract on Thursday night at 11 p.m. or midnight until 8 o'clock the next morning before we got something. That was a sleepless night, but we were in constant communication with you, with the seller, with the broker, everybody the whole time. And that's why sellers and brokers want to close and award deals to people that they know can get the deal done. I feel like that if a smooth closing happens, everybody just sort of high fives and it's a smooth closing. Oh yeah, those guys close smoothly every time. Well, what happens when it's completely out of your control? In this case, it was the lender, Freddie Mac, right? They hold all the cards. And so we just had to fight through it and give assurances to the broker and the seller. We had to put some more money up hard to get these extensions. But now I believe that the broker and the seller know that if they're ever in another deal with us, that these guys are not only going to say what they do, they're going to fight through whatever the issues are. And that, to me, is worth more than guys that just close smooth. Because you want to, if you're in the trenches, and all 3 of my partners are military guys, you want to be sort of with somebody that knows how to deal with shrapnel and bullets flying. And that's effectively what was happening through no fault of our own for that last week and a half before we finally got to close on September 12th.
I know it doesn't feel like it, but I feel like every deal, you guys don't see it, but every deal is like this deal in terms of the pain that it's taking to, get through some of these deals, especially on the Fannie Freddie side, especially on the buyer, like bridging that gap between buyer and seller, because it is hard to negotiate when you are out of contract, right? But then to go back to the seller and say, look, are you going to start this process over with somebody else and have Freddie look at this deal 4 months from now? Or are you going to sell the deal a week from now, right? And so it is definitely, you hope that all the negotiation is done, when the PSA is signed. But in almost all these acquisitions, the negotiation has just started when the PSA is signed. It is just beginning. So you guys definitely fought your way through it on this one.
Well, what's the bottom line? Did it close, James, or didn't it close?
Well, yes, it did close. Has it been about 2 months or 3 months since you guys have been closed on this deal? And then talk about how you guys are managing this property, because I think it is a little bit more unique on this particular property.
Yeah, I'll take that since I'm the boots on the ground here. So 64 units is sort of that, it's in that tweener space. On-site, this property had been on-site managed, but it had been on-site managed with a group that had several other properties nearby. And so they could figure that out. But as our only deal, as Convolot's only deal in this market, we didn't really have that luxury. So the good news is that we had experience in Atlanta dealing with property management that was not on-site. And so we knew that there was a place for that. And so I was networked with groups that did that kind of work. Smaller multifamily, single family types. And so we hired used to being centralized and used to not having people on site. It's been challenging in a sense because this property has been managed from site for a while. And so the residents during takeover, even though we were trying like crazy to communicate with them, it's been challenging. I come from a space at CAF where we were a lot of units and extremely professional on-site teams. And so there is a paradigm that can sometimes have to get shifted a little bit whenever if you have a full-time leasing person that's your property manager, a full-time maintenance person, which is what this property had, then your residents can somewhat get spoiled. I hate to say it that way, but that's the reality. Yet 64 units doesn't justify the payroll on that. It's just hard. It's hard to look at $2,000 plus per unit on payroll, which is what the property was effectively running. So we chose part of our underwriting from day one was, hey, we're going to use a centralized team that we feel like can perform, and we're going to have a more hands-on approach from an asset management perspective. I go over to the property once a week. It's 30 minutes from my house. It's right next door to the apartment association where I have monthly board meetings. So it's just nothing for me to drive right over there as a part of my routine and check on things. We put some cameras up just so we could see what's going on. And honestly, we're still right in the middle of all of that, trying to sort of figure out what works, what doesn't work, how does leasing work, all of that. But we will fight through all of those things too, because we know that the property, to Paul's point before, is it's got good bones. It's in a good place. It's on the northern part of Irving, not quite Las Colinas, but it's what I would say is it's the part of Irving that supports all the things that are happening in Las Colinas. If you're familiar with the hyperlocal market, and there are a lot of units nearby, but it's right next to the preschool, the elementary school, and the middle school. And so there's just if you're over there at 8 o'clock in the morning or at 3 o'clock in the afternoon, be prepared to wait in some school zones, because that's what it just is all around there.
So I think we touched on the bus tour coming up in January. So we're going to drive by and see this property on the bus tour. So if you want to see this property, meet Jeremy and the whole crew, definitely sign up for that event. But I guess in wrapping this story up, I mean, you guys have been sort of in the space for a while, have talked to a ton of people, seen people do well, seen people do not so well. Maybe to wrap this up, number one, give us sort of how best way if people want to talk to you guys about this acquisition or future deals, give us a way to reach out to you guys, and then also wrap up with just sort of one or two nuggets of what you guys would advise for the aspiring multifamily guys out there.
Yeah, you can reach out to us at convolocapital.com. I'm sure James and Paul can link it up in the show notes, but convolocapital.com. I'm Stephen at convolocapital.com for email, and happy to connect with anyone and share more of my background. I'm happy to share more of how I got started. I'm happy to add value to anyone in any way, so happy to do that. In terms of advice for anyone, I would just say that just off the cuff here, I think that getting the right partnerships down is important. I think that's the team is paramount. You have to have the right people. You have to have people that think differently than you, hopefully have an offsetting skill than you. And I think that's super important. And then, because you can't do this business alone, no matter how much you think, it's just not possible. And so I think surrounding yourself around with a good team, not only your general partners, but LP investors, vendors, debt brokers like Old Capital, the list goes on. You just need to surround yourself with the right people and the networking that's required. Jeremy and I have been doing this for years, building the foundations, building the roots and the network to be able to execute on a deal like this. So I think starting now and thinking about it long term, it's a very long game. You don't think about it in a couple of years. You think about a 10-year time frame. That's how you should be thinking about it in terms of the relationships that you're building now. So that's what I would say.
Yeah, and I'm Jeremy, so Jeremy at convolocapital.com. And everything Stephen said was important. Don't underestimate the value of education. And there are great education groups that are out there to accelerate that, but there's also free ways to do it. And if you listen to all 500 Old Capital podcasts, then you don't need any education, you don't need an MBA. It's all there for you. It's just a matter of finding those resources in time. I'm on the board of the Apartment Association here in Dallas. That's a great resource for people as well. There's just a lot of, for all intents and purposes, free resources that are out there for you to educate yourself with, but you're not going to really be effective at this business in your home office or behind a screen. The great Michael Becker talks about how this is a people business. Relationships matter, whether that's future equity check writers, future vendors, future partners, whatever the case may be, you're probably not going to get to cultivate that relationship digitally. It might start digitally, but you're going to need to go to meetups. You're going to need to go to events. You're going to need to shake hands with people. You're going to have to laugh at some unfunny jokes. That's just the way this works. And once you've figured that out, then you'll find yourself on an Old Capital podcast at some point. It's just sort of the way this works. And I'm a testament to that. And I have James Ng to thank for my addiction to multifamily.
James, any last words before we wrap this up with Stephen and Jeremy?
No, I mean, these guys have been through it. And I mean, just starting with Jeremy's initiative of not only, like, we were in completely separate businesses, and finding someone just a little bit ahead of you. Like, I wasn't that much ahead of him, but just a little bit ahead of you to find someone to latch onto and learn from, and then sort of ratcheting up. And then Jeremy was introducing me to people all along the same time and same way. Just starting there, building the team, I think is key, but then also just executing. And these guys have done it, not only going from 0 to 1, but to 0 to 5, 6, 7, 8. I think these guys have a ton of potential over this next sort of cycle that we're going to go through on the multifamily side. So reach out to them and get to know these guys better.
Great information, guys. We certainly do appreciate that. Appreciate the help from Jeremy and Stephen and all the good folks over at Convo Capital. So James, thanks for leading the discussion today. I'm Paul Peebles. Have a good day.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.